Hey everyone, in this lesson, I want to talk about an alternative trade setup to the weekly double calendar. We started doing these in the alerts, this little tweak to the strategy, because at the time of this recording, as you can see, we had the huge downdraft in stocks due to the whole coronavirus situation and a big rebound, but implied volatility has stayed elevated this entire time. And so there are some key things to look at when entering these weekly double calendars, and I'm going to go over that right now. So what we're doing is if we go to the Analyze tab, you'll see I just put one of these on. Okay, so this is kind of a little bit more of what it looks like. And as you can see, there's a big droop in the expiration line, and that's okay. Because what you'll notice is that we're doing a couple things. One, we're still using the 6 to 8 days to expiration in the front week. Okay, so that does not change. So in this case, we entered this trade with 7 days to expiration in the front week. The difference is instead of going out to 20 or 21 days in the back week, we're going to the next expiration cycle, which in this case is 10 days. So just a 3 or 4 day difference between the front week and the back week. And there's a couple reasons for this. One, because implied volatility is so elevated, by doing this, we're not having to use as much capital. So you can see capital used on this was under $1,000 for one contract in SPX. If we utilize the normal strategy of going out, doing the front week in 7 days and the back week 21 days out, with the elevated implied volatility, I mean, we're talking about 4, 5, 6. I've seen as much as $9,000 or $10,000 per contract just to put this trade on. So that's one reason we're able to get into these with a lower buying power requirement. The other thing is if you take a look, so this is today, and these expire 6/20. So we like to get out of these either kind of 1 day to expiration or 0 days to expiration. So if we just go ahead in time, go to the 18th, this is 1 day to expiration. What you'll notice is that the P&L line, and this assumes volatility and price stays the same, but the P&L on that day, I mean, we're talking about a potential profit of between $700 and $800, let's say. Well, remember, we only are using less than $1,000 in capital to get into this, so the return on capital is just amazing by doing it this way. So that's the other reason. The other thing is, if we go back to today and we look at our price slices, I mean, we're talking about an initial probability of profit. Now, again, remember, the break-evens will fluctuate, the max profit will fluctuate based on implied volatility, but at initiation, we're talking about a 68% probability of success, between now and expiration. So just some really good risk-reward metrics, and they've done really, really well. I mean, ever since implied volatility has been elevated, we've been kind of tweaking it using this alternative setup method, and it's been extremely profitable. And, of course, we've still taken a few losers, but the losers are a lot smaller and our winners are just as big or bigger. So if I compare this to the traditional one, let's just set this one up just to show you an example because of what implied volatility is doing right now. Oh, and then one other thing before I do that is instead of using the 40 delta, because of the elevated implied volatility, we're going all the way out. I think when I set this up, it was closer to like 27 delta. But when we set this up, we're anywhere from 25 to 30 delta are the deltas we're using both on the call and the put side. So instead of using 40, which is closer to the money, we're using 25 to 30. So we're getting much wider. And that's why I was showing you that higher probability of profit. Let's set up a traditional one in this environment just to show you the difference. So if I use the 40 delta by double calendar, and then I go over here on the 40 delta, which would be the 2980. So I'll set my puts at the 2980, 2980, 2980, and then we change our back week expiration to the 20-day, which would be July 2nd in this case. So I'm going to move this out to July 2nd. And then we take this over to the Analyze tab. And let's look at the difference. Okay, so I'm going to uncheck this one. So here's our current one. Remember, we got about a 69% pop. We're using about, let's just call it $1,000 in buying power, $979 in buying power. If we move to, near expiration where we would take this thing off, we're at this time, we're talking about a profit of, let's just call it $800, close enough, okay? So remember those numbers, and then let's click on the one that I just set up. And so a couple things. Let's go back to today's date. If we move our price slices over to the break evens, obviously it's going to be a much more narrow range, and we're talking about in this case, a probability of profit under 50%. So we're going from a 68 down to a 50, so a lower probability of profit. And then look at what we're talking about to put on one trade. I mean, we're paying a debit of $65.25, so over $6,500 to put this trade on for one contract. I know a lot of people, that's more than they really want to do on a per trade basis. So that is the difference. Now, so the last thing I want to talk about is the exit. So on this traditional one, we would typically exit at about 25% of debit paid, because obviously it's much more narrow and the amount of buying power we're using is much larger. So we're exiting at about 25% of the debit paid. So if we got down, in this case, we're paying $65.25, and this is all explained in the previous videos, $65.25 times 0.25. So we're talking about if we got down $1,600 on this trade, that would be our exit point. Okay, so that and again, because we're using so much capital, taking that kind of a loss on a per contract basis may be more than you want to do. So that's a big trade. So a lot of people would be kind of priced out of this. So with the alternative method that we're talking about today, because we're using less capital, because we have a higher probability of profit, we're taking these off at about a 50% of debit paid. So in this case, we're using $1,000 in capital, so we would take this off if we got down $500 on the trade. So those are the things. Let me review this one more time just to summarize it. 1, we're entering with 25 to 30 on the deltas. We're still using 6 to 8 days on the front week, but the back week is only 3 or 4 days later. And then our exit is about 50% of debit paid. We're still closing out winners, 1 day to expiration or 0 days to expiration on the last day of trading. Either one of those is fine, depending on kind of where price is. But that is the alternative. Hope that helps. We are doing these as alerts. I know there's been a lot of questions about why we're doing it this way, and we've talked about a lot on the weekly videos, but I wanted to put this in the course so you have it, and we'll continue to trade this way, especially in the way that implied volatility levels are sustaining at this point. So hope that helps. See you in the next lesson.